What if the retirement roadmap they handed you is completely out of date? You did everything right. You worked hard, you saved your money, you trusted the system. But now, with retirement staring you in the face, you look at your savings and you can't shake the feeling that you're losing ground. You're watching the value of your dollar get eaten alive by inflation, and the so-called safe plan feels anything but. You're playing a game where the rules are constantly changing to your disadvantage. They tell you Bitcoin is a digital casino, reckless gambling for someone in your position. But what if the real gamble is having zero exposure? What if ignoring it completely is the riskiest move of all? In this video, we're going to tear apart that conventional wisdom. I'm going to show you the simple 1% rule that isn't about wild speculation, but about protection. It's a strategy financial insiders and the world's biggest institutions are using to build a defensive wall around their wealth. And it's a framework that could help safeguard your retirement without risking a catastrophic loss. So buckle up, because the math we're about to explore might just change your entire future. For generations, the path to retirement was built on the 4% rule. The idea was simple. You could pull out 4% of your portfolio, adjust for inflation, and your money would last. But that world is gone. That rulebook isn't just bent, it's broken. We live in a world where inflation remains a persistent, silent force, quietly eroding the value of your life's work. This isn't an accident, it's a feature of the current financial system. And even the man who wrote the old rulebook, Bill Bengen, knows it. He recently updated his guidance, stating that a more diversified portfolio could actually support a withdrawal rate closer to 4.7%. Why? Because the old model is cracking under the pressure. Bonds, the asset that was supposed to be your safe harbor, are struggling to keep up with the cost of living. This leaves you in a terrible spot. You're caught between the fear of a volatile market and the certainty of your purchasing power diminishing every single year. This pushes people into a flawed, all-or-nothing trap. You have crypto evangelists yelling, "Bet the farm," and traditional advisors yelling, "Don't touch it." Both are missing the point. The intelligent move isn't about going all in or staying all out. It's about finding the sensible middle ground. This brings us to the core of the strategy, the 1% to 5% Bitcoin rule. Let's be crystal clear. This is not about getting rich quick. This is a disciplined, calculated hedge against a broken system. Think of it as portfolio insurance built on a concept called asymmetric upside. In simple terms, it means the potential for profit is exponentially higher than the potential for loss. With a small 1% to 5% allocation, your downside is strictly capped. Let's run the worst-case scenario. If Bitcoin, against all odds, went to zero tomorrow, a 1% allocation means your entire portfolio only takes a 1% hit. For a well-managed retirement, that's a speed bump, not a catastrophe. But the upside, that's where things get interesting. Because of Bitcoin's unique properties and historical performance, even that tiny 1% slice has the potential to have an outsized positive impact on your total returns. You capture the massive upside potential while putting a hard limit on your risk. It's how you participate in a global reset without betting your retirement on it. Keep in mind, past performance isn't a guarantee, and markets can change rapidly. So how do you actually do this? Let's move from theory and break down the real numbers. The key is to tailor this to your situation, never taking on more risk than you are comfortable with. Let's ground this in a few real-world scenarios. For a $500,000 retirement nest egg, a conservative 1 to 2% allocation is just $5,000 to $10,000. Research from a financial giant, Fidelity, suggests an allocation in this range can have a meaningful positive impact on retirement outcomes. This is a small, disciplined move that won't have you losing sleep. For a $1 million portfolio, a 2 to 3% allocation, or $20,000 to $30,000, could be appropriate. It's still a tiny fraction of your total wealth, but it's an amount that could provide a serious boost to your portfolio's growth, helping you crush inflation over the long term. For high net worth retirees with $2 million or more, a slightly larger 3 to 5% allocation might be considered, which comes out to $60,000 to $100,000. At this level, your capacity for risk is higher, and the diversification benefits of a non-correlated asset become even more powerful. This tiered approach ensures you are never overexposed. This is about making a small, intelligent adjustment to your plan, not throwing the whole thing out. Now, I know what you might be thinking. This still sounds like a fringe idea. That couldn't be further from the truth. The era of Bitcoin being a niche interest for tech enthusiasts is over. The biggest names on Wall Street are now positioning themselves accordingly. The approval of spot Bitcoin ETFs in 2024 was a landmark event that legitimized Bitcoin as a portfolio asset. This wasn't some back alley deal. It allowed BlackRock, the world's largest asset manager, and Fidelity to offer regulated Bitcoin products directly to their clients. The floodgates opened, and over $100 billion in dollars have poured into these US-listed ETFs since their launch, as of early 2026. But don't just watch the money flow. Look at the research they're publishing. Fidelity Institutional put out an analysis showing that a portfolio allocation of 2% to 5% in Bitcoin could have a positive impact, while, and this is the key part, limiting your portfolio's worst-case loss to just that small allocation percentage, even if Bitcoin's value went to zero. Morgan Stanley has gone on record advising that an allocation of up to 4% could be suitable for their opportunistic growth portfolios, and has even referred to Bitcoin as being akin to digital gold. These aren't rogue traders. These are the institutions that manage the global financial system, and they are building the frameworks to include Bitcoin as a legitimate piece of a modern portfolio. All right, let's address the elephant in the room. I need to be 100% real with you. Bitcoin is an extremely volatile asset. Its price swings are legendary, and for a retiree, that's a legitimate concern. This brings up something called sequence of returns risk. The danger of a big market crash happening right when you start making withdrawals, which can permanently cripple your portfolio. So how do we manage this? First, the 1 to 5% rule itself is your primary shock absorber. By keeping the allocation tiny, you insulate your retirement from the drama. A gut-wrenching 50% crash in Bitcoin is a major headline, but for your portfolio with a 2% allocation, it translates to a measly 1% dip in your total net worth. It turns a speculator's catastrophe into a disciplined investor's manageable fluctuation. Second, this is not a trading strategy. You are not trying to time the market. The idea is to buy and hold for the long term, treating it as a store of value that exists outside the traditional system that is constantly being debased. Third, use a dollar-cost averaging DCA approach. Invest a smaller fixed amount on a regular schedule. This smooths out your purchase price and takes the emotion out of trying to buy the perfect dip. The key is discipline. You have to be mentally prepared to watch this small slice of your portfolio go through wild swings without panicking. The rest of your portfolio provides stability. This small allocation is your hedge against the slow, silent killer, the debasement of currency. While others debate if it's a perfect hedge, one fact is undeniable. Bitcoin's supply is mathematically fixed at 21 million, a stark contrast to government currencies that can be, and are, printed into infinity. Now, deciding to allocate is the first step. The next is understanding the practical side, like the easiest and safest ways to buy and hold it in your existing retirement accounts. If you're wondering about those next steps, I break down exactly how to use these new Bitcoin ETFs in your brokerage account in my next video, which you can find right here. The financial world is changing. The rulebook our parents followed is failing an entire generation. You have worked too hard for too long to just sit back and watch your savings get devalued. The 1% Bitcoin rule isn't about blind faith, it's about clear-eyed risk management. It's a blueprint for thinking differently. It's an acknowledgement that in a world of endless money printing, holding zero exposure to the planet's most secure decentralized asset might be the riskiest position of all. By dedicating a small, strictly capped portion of your portfolio to Bitcoin, you are not gambling. You are diversifying. You are building a resilient portfolio for the challenges of this century. You are taking one small, calculated step to protect the nest egg you've spent a lifetime building.